Thanks again for being here, Alisha. It's been a couple of weeks since we last spoke, and the market activity has certainly been interesting in that there's been some neutrality, some upside, yet nothing really to write home about, for lack of a better term. One of the things that's been really prominent here over the past couple of weeks has been that discussion of recession, right? Whether we're in one right now or soon to be one, and the implications of that from an economic standpoint, demand, markets, you name it in general. And I kind of want to focus on that because I do think we're likely in a recession right now, yet that can seem notably scarier than the reality might be. And I think to build our base case there, let's focus on some major differences between where we're at today relative to the previous recession, previous to COVID, I should say, being the worst since the Great Depression, in what has been dubbed the lack of current prudential risk, right? Walk us through a little bit kind of what that is and how things may be potentially different this time around.
Prudential risks in the environment can stem from housing issues and other bubbles that are bursting, like in 2000, 2001, where we had the tech bubble burst. We are not seeing any issues right now in the housing sector. Financial institutions are strong. Consumer balance sheets are strong. Businesses are strong. The labor market is strong. We're just not seeing that excess prudential risk in the environment right now.
Yeah, outside of maybe interest rates being in that restrictive stance, you're right. I mean, things look fairly different. We like to track just general cash flows and liabilities on balance sheets. Looking at the S&P 500, things look significantly better by 2 to 3 times as they were back in 2008. So it's very difficult to buy into a true sustained downside risk from that standpoint. What's also interesting year to date, and this year rather, is something that has not made the media headlines much, is that we're in a midterm election year. Right? Elections are coming up, and starting here probably in late summer, late July, maybe early August or early September, our favorite political ads are going to start popping up, right? And without getting on which political side is better, right? Let's talk a little bit about the seasonality of the markets when we're talking about midterm elections, because we've went and looked at data since the 1930s in every midterm election year that happens every 4 years, and walk us a little bit on the dynamics that we see both from a volatility standpoint and a potential return standpoint across that.
Sure. So let's start about the returns. Looking back since 1930 and looking at quarterly S&P 500 returns, they've been very neutral in quarters 1, 2, and 3. I think on our commentary, we display that returns are between negative 1.25 and 1.5% during those quarters. When we look out further into Q4, we're seeing a rebound in market returns. Markets don't like uncertainty. By then, the uncertainty surrounding midterm elections is done, and we tend to see a bounce in the tune of about 6% in Q4. Looking at volatility, we have noticed that volatility is enhanced during midterm election cycles, which we are seeing this year. Yeah.
So what I'm hearing is the seasonality of this invisible hand, I want to call it, for midterm elections, right? It's very difficult to pinpoint volatility in a single catalyst. Is increased volatility with the seasonality showcasing fairly strong returns on a 12-month forward-looking basis. We don't have a crystal ball, and certainly we do not employ or generate capital market expectations. But we have fit the mold fairly well in the volatility profile year to date, being through the first half of the year close to that 19-20% downside, with the average being around 17-18% downside peak to trough during midterm election years. So from that standpoint, really we're fitting that mold fairly well there. And I want to touch base quick on the recessionary discussion one more time. And I want to stress the fact that this recession that we may be in or about to arise, we're dubbing it the getting back to trend recession. If we look back at COVID, if we look back at the notable downside extremes that were met by notable upside extremes, whether it was retail sales, commodity consumption through refined products like gasoline, whether it was capital markets in general, bonds, stocks, you name it, we captured tremendous downside, tremendous upside, and now we're getting back to trend. But it's very easy to get notably pessimistic about that in the very short term. So as we look at that over the next 12 months, relative to bonds, as an example, right, given what stocks are at right now, let's talk a little bit again about our stance on equity market participation and kind of where we see things to be likely better from a positioning standpoint across portfolios.
Yeah, piggybacking on your sentiment comment, consumer sentiment and business sentiment is small business sentiment is very poor right now, and we think that is overdone, and we think that we could see a rebound in equities throughout the next 3, 6, or 12 months. So we are strong proponents of equity market participation, and we think that returns there are much stronger than what we could find in the challenging fixed income environment.
Yeah, fixed income, no good, at least from our standpoint.
Exactly.
Great. I want to end this by saying, on the economic front, I think the market in general is mispricing, we believe, the potential pop to the capital markets in the event of a positive economic surprise. I think that becomes the biggest risk in exiting equity market participation. It's certainly something we're keeping a very close eye on.